Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Liz Thomas of SoFi writing, it would take a lot to not get a cut in September. The Fed is more focused on labour in the near term. But over the next few meetings, I suspect the focus will shift to inflation. Liz joins us now for more. Liz, welcome. Let's build on some of that. The shift back to inflation, what's going to bring that about?
Well, when you think about where we are right now, first of all, the message that we received from the Fed on Friday was that the labor market had cooled. There's this average of 35,000 jobs added per month over the prior 3 months, which is a number that at least concerns them, and they want to make sure that they don't lose track of that. But I think what will happen as time goes on is us knowing and the realization in markets that there's no room to hike rates. There's a little bit of room for the labor market to cool before the Fed and before really the economy is going to look like it's in a lot of pain. We've got an unemployment rate still at 4.2%, and the expectation as of now is that it'll stay at 4.2%. So there's a little bit of room there for the labor market still to cool off. There's definitely not room to go back and have to hike rates if we lose control of inflation. But the other message that I think was very clear from the Fed on Friday was that, yes, we expect some effect from tariffs on inflation, but we're not going to see it immediately. And we're not sure if it's going to be just a one-time thing or if it's going to take a little bit longer. So that's why I say over the next few meetings, I think the focus will shift back to inflation as some of that data comes through, and if they can get confirmation that tariffs were just a one-time shock.
Liz, do you still see it, though, in the same way the market saw it on Friday, that the chairman's current reaction function, the policy bias, is a pro-risk one?
Well, on Friday, what happened, I think that surprised markets was that he pretty much confirmed as long as things continue in this fashion, we're getting a cut in September. He didn't say that explicitly, but that was the interpretation. The other thing that happened on Friday that I think is a little bit lost in the huge rally is that before that speech occurred, markets had gotten down to less than 70% chance of a cut. So a lot of that was just repricing back up to, I believe it hit a high on Friday of maybe 90, 91%, 93% chance of a cut. So the repricing from 65-ish% back up to the low 90% was a lot of that rally. So just sort of a rejiggering of our expectations again. Is this a sentiment shift to back to risk on? It was risk on already. I think where we're at now is we're back to having priced in this first cut and really wondering, does that mean that there's another one to come? Is this the beginning of a cutting cycle? And how aggressive will this cutting cycle be? I still think that the jobs data next Friday is going to decide for sure whether or not we're getting that first cut. If it comes in at expectations, even slightly weak, that cut will be all but baked in. We're actually below 90% chance right now, but that cut would get all but baked in, maybe even another sniff of 50 basis points, which I don't think is likely. But in the near term, yes, this is positive for risk assets. At some point, if this is the beginning of a cutting cycle and if it starts to be in response to weak data, the market will have to digest the fact that, okay, the economy is now cooling quite a bit. We were cutting because we could. Now we're cutting because we're trying to prevent further weakness.
If this is the start of a cutting cycle, though, how could it be when the chairman himself said that tariff effects will be accumulating over coming months with high uncertainty about timing and amounts?
Well, that's what I think the market's going to have to figure out. Right now, we're acting as if it is the beginning of a cutting cycle, and this is going to be a slow message to keep going down further and further as the year goes on. We're pricing in a little bit more than 2 cuts right now before the end of the year. if you look at the time period when it might take tariffs to actually work their way into the data, and when I say the data, we've already seen some effect of tariffs in PPI data. We're looking for it in consumer price data, so CPI and PCE, and it'll take a little bit longer to get there because if the companies are not passing it through on the PPI side, on the wholesale side, it's going to take a little while to see that in the consumer side to the end result. So usually, let's say it takes 4 to 6 months for that to actually work its way all the way through the system. The Fed knows that. So they're buying themselves some time to say, okay, let's watch and see what happens over the next few months of inflation reports on the consumer side before we signal anything, promise anything to markets that this is going to be a slow cutting cycle that will continue.
Liz, what are you looking for in terms of the data we have yet to see when it comes to the August payrolls and CPI report that could maybe make Jay Powell walk back this idea of a cut in September?
Well, one of the things that I had been saying even before Jackson Hole was we're getting really excited about a cut in September when we've got a lot of data still to come. So we know that the CPI and the PPI data was a little conflicting. CPI came in okay, if not slightly weak. PPI came in really hot. So there is already some conflicting message coming from the data. We've got another CPI report. We've got the jobs report, obviously, which everybody will be watching with bated breath. We've got a PCE report. So there's still a lot to come. If some of those come in hot, especially hot, then I think we're going to see a lot more uncertainty before that meeting. But I do believe that it would have to be a series of hot data. So it wouldn't just be a one-time pop in CPI, a one-time pop in PCE, because they've already messaged to us that that might happen anyway. So I think unless this jobs report comes in really, really hot, I think we're getting that cut.
The jobs report is what I want to talk about, Liz. The prospect of an activity rebound. Can we just get into that a little bit more? I've seen that from Bank of America on Friday. Heard Mizuho talk about it too. Jordan Rochester said it's hard to get too dovish if US growth momentum from PMIs is real. Liz, how do you think about the prospect of a growth rebound as we work our way through September into year end?
Well, I think that's part of what the market is counting on with this broadening out trade that it's started to do over the last couple of weeks. You're seeing some strength out of smaller cap names. You're seeing strength out of other sectors besides communications and tech, and even outside of industrials, which has been one of the top sectors this year. So the broadening out trade is enthusiasm that we will have some sort of growth rebound, activity rebound that's durable and can reach into other parts of the economy. I think it's possible, but it's too early to say, okay, this is a growth rebound that's going to look like early parts of a cycle. Because if we're just embarking on a cutting cycle again during this period, we have to really wait for confirmation of some of that activity. And the reality is that the data had been moving in the opposite direction coming into this. Hadn't been moving in a terrible direction, but things were cooling off. GDP was cooling off a little bit. The labor market has really been stagnant in a solid place.
True.
Stagnant in a place of strength, but stagnant for a long time. So it would take some really exciting news or some shift in economic developments to, I think, broaden out the growth in a durable way right now.
Stay with us. More Bloomberg surveillance coming up after this. Steve Ricchiuto of Mizuho isn't convinced it's needed, writing the following: should the Fed ease policy as the markets expect? Analysis suggests the primary risk to the economy is a backup in long-term interest rates. Steve joins us now for more. Steve, good morning.
Good morning.
Just tell us, what do you think's brewing here?
Well, I think there's a bit of political pressure building. I think there's a bit of dovishness within this committee that has been brewing over years. And I think when you combine it with a misperception as to how restrictive monetary policy is, you wind up in a situation where you get a chairman making a statement like this, leaving a door open to a rate cut when he himself and his own balance of risks is completely balanced. The risk to the upside on inflation The risk to inflation is to the upside. The risk to employment is to the downside. Well, okay, what are you supposed to do? Well, the answer is if I think it's restrictive, maybe I can cut rates. If I don't think it's restrictive, then I should be doing nothing. How do we define restrictive? That becomes the problem.
The thinking at the moment appears to be that, yes, we're facing upside risk to inflation and downside risk to employment, but the downside risk to employment are more important because the upside risk to inflation won't be as pervasive and we won't see the second round effects because of the downside risk to employment. How do you think about that issue?
You have to show me that's the case. Historically, yes, there are important transitions that take place in terms of the labor market that happen more quickly than on the inflation side of the equation. Don't argue with that. Is this one of those conditions? The answer is no. You have an economy that is fundamentally healthy. You've got an economy that accelerated or rebounded right now very, very sharply after the second quarter GDP. You've got an economy that's showing you have healthy consumer demand. You have an economy that is going to be above trend economic growth in the current quarter against the backdrop of a consensus forecast of 0.9% growth. And so therefore there's a disconnect between the reality and the perceptions. And I think that's part of the problem. The other thing, I think when you're looking at the coverage of this, everyone's focused in on the opening up the door to a rate cut. The chairman said a couple of things. One was that basically that he didn't think policy was that restrictive, yet the market has 5 rate cuts priced in. That's number one. Number two, if you look at the framework changes, everything they did in 2020, which was adopting a Keynesian style of monetary policy, is gone. And they've readopted a Taylor rule approach to monetary policy, which is a symmetric monetary policy guide frame. And when you look at the Taylor rule type models, monetary policy is not restrictive.
So you mentioned, though, at the start, because there's one other dimension happening here. You said it is a little political. Do you think his speech Friday was political?
Well, I think they may get into a situation where the chairman said, okay, I'm going to open the door to it and let's see what the committee does. Because there seems to be this perception inside the White House and inside the Treasury that the chairman can determine where monetary policy goes. So if the chairman opens the door to a rate cut and the committee votes and doesn't vote for a rate cut, then guess what? It's not just one vote.
Bob Elliott was saying that he potentially was doing this to protect the Fed as an institution. But it sounds like what you're saying, he's protecting himself.
Well, again, protecting the Fed as an institution. Yes, the institution seems to be under attack, but it's always historically been under attack. We went through a very, very calm period, where we did not attack the Fed from basically Paul Volcker on. We're now back in the more political environment of these things, and we've historically faced these dilemmas. I think the real issue for the Fed in here is not just maintaining its independence, but maintaining its credibility. Okay, what is your framework? Is your framework a symmetrical monetary policy? Okay, if it's a symmetrical monetary policy, then live up to the symmetrical monetary policy. If it is still a policy skewed towards the labor market issues, i.e. it is the more equal of two equal framework or guidelines, then be clear about that. And this, I think, opens up the bit of the dilemma for what we're dealing with today.
Do you think we could see a repeat of last year? They drop rates at the front end and we start seeing problems at the long end?
I think that's really the underlying risk that they face. Now, again, could that be then a message to people on Capitol Hill that believe, well, if you lower short-term interest rates, long-term interest rates automatically come down? The answer is yes. That may be, what has to happen to get it done. Is 25 basis points going to matter one way or the other? No. Will 125 basis points matter? Yes. And that's really the difference here. I don't really care if they cut rates 25 basis points in September. I care about what they do with the dots. Do they now look at their different framework and say, okay, we're back to the pre-2020 framework. Well, what should the dots then be going forward? Should the dots still be for the number of rate cuts we envision against an environment where we have an economy that's going to continue to grow and we have inflation in our forecast that's 100 basis points above our target?
Steve, this is really important. What I hear from your analysis is a clear distinction between whatever they do on September and then the rest. Yes. And the rest is far more important. Do you see scope then for a hawkish surprise on the 17th?
Well, the problem is the dots, because the dots aren't set as part of policy. They go into the meeting having delivered their dots. and their SCP, and therefore it's just a calculation. So, and unfortunately, the market only pays attention to the dots. It is the intellectual gravity well, okay? Once you put that dot out there, all thought process in the market goes to explaining that dot and forecasting what's going to get that dot to happen. Nobody thinks of anything else outside of how does that dot get validated. And that's where the market is. So as long as those dots run the risk of being there, I think you might wind up with a greater divergence in the dots in September. And that may be the thing that matters.
Stay with us. More Bloomberg surveillance coming up after this. So here's the latest this morning. Bond yields plunging on Friday after Fed Chair Jay Powell signaled a possible rate cut in September, ending an 8-month pause. Robert Tipp of PGIM writing, the attention to the growth side of the Fed's equation is also a welcome development, suggesting the Fed is attuned to downside economic risk. Robert joins us now for more. Robert, welcome to the program, sir. Let's just reflect on what we heard from Chairman Powell. What is he setting us up for going into year end?
I think he set us up for doing whatever the data told him to do. You know, he opened up to rate cuts with one sentence. You know, before that sentence, he was talking about inflation and the concerns on the inflation side, which are very real, frankly. You know, he got it wrong on the data, and he really pounded the table at his last press conference about how decent the labor market was and they weren't cutting. And then he got, 3 months worth of bad data in one go on that Friday. So he opened the door to the rate cuts. If they get another ratification of the weak data, he's opened the door. They can cut rates. He can work with his committee. But he bought time, and he bought the ability to act independently because the Fed is not independent. They have to be very careful.
Robert, he also redefined what weak data actually was. We'll get to central bank independence in a moment. I want to sit on the labor market. Last time around in the news conference, he talked about the labour market being solid and anchored that view around the unemployment rate, almost that data point alone. And now he's looking at a simultaneous step down in the supply side of the labour market and the demand side and putting more weight on one versus the other. And I'm just wondering, Robert, where you think that's come from.
Yeah, I think that data is incredibly light in terms of sampling. I'm not a statistician. I'm not an economist. But it's not that many households. It's not that many businesses. And so you need a couple years before that data begins to settle down with all the revisions. And so if you add, subtract, and God forbid, start dividing those numbers and getting unemployment rates, you have a tremendous amount of risk in interpreting those. So, I think the economy is doing reasonably well, but to his point, when you get downward revisions, they tend to have positive serial correlation. You tend to keep seeing them. Some research says, that doesn't correlate with recession. Some shows that it does. And I think you and I know that often with recessions, you look back, they say, 6 months ago, we were actually in recession. We didn't know it. He's feeling that risk. So he's adjusting. Nobody knows what to look at in terms of the data. But I think that's why he's struggling and everybody's grappling with that information.
After this speech, is he setting up the market to pay more attention, though, to the labor market report that comes out?
I think the market always thought the labor market was more important. And in fact, if you just look at the COVID experience, as long as they were concerned about the labor market, they weren't hiking interest rates until they were absolutely sure, the labor market's probably okay. And wow, inflation is way, way, way too high. So this is a Fed that has been trained. This is the third Fed of the United States. And, the most public, strongest opposition to Fed independence was probably in the 50s before their independence with Truman. Humphrey Hawkins, after a very brief recession in '69, in the 70s, they wrote this, dual mandate, which actually has more parts to it. It's a very employment-heavy mandate. So I think that the markets already realized the Fed would lean on that because the Fed's independence can be shaken by Congress and the board itself can be attacked as well.
You said earlier the Fed is not independent? Do you mean because their mandate is back to someplace, and that's Congress, that's the lawmakers?
Not only is it made by the lawmakers, they set the targets, but this is a president that can legislate effectively. I mean, we saw this with the budget, where he pushed something through that touched entitlements in fast, lightning speed, and bent the budget rules, right? And maybe, I'm not saying whether this is right or wrong, I'm just trying to adjust to reality here. What's possible in this environment? These people that are voting on the rates are under tremendous pressure. They can come under attack from the Justice Department, but at its very fundamental, basis, the Fed's mandate is set by Congress, Federal Reserve Act, Humphrey Hawkins. It can be changed at any time. So I thought he was very artful. It wasn't like 2018 or a little bit earlier in this cycle where he fought on the interest rates, laid out the situation, said things are falling out on the side of ease here. And that's the best way to maintain the ability to act independently, is to not fight it, go with the data, do the right thing in the eyes of the current zeitgeist.
Well, Robert, let's talk about what the White House ultimately wants. And it's not just about lower interest rates of the Federal Reserve. It's lower borrowing costs and lower mortgage rates. Robert, if they drop rates of the FOMC, are they going to get lower borrowing costs and lower mortgage rates?
Well, they have a lot of tools. I left out actually the shadow chairman of the Fed running the Treasury. They're pulling in the issuance towards bills. They're buying back bonds, right? So they can, and they've signaled they're not interested in issuing more long-term securities. They're interested in issuing more T-bills. So if they can get a lower short-term interest rate, rightly or wrongly, and issue more bills, you're not going to have a runaway cost of issuance, over the next 3.5 years.
Are you, as an investor, less concerned then about what happens at the longer end of the curve?
I think that if they, in fact, run policy that's reasonable, which I think they will. As you pointed out, there's a wide range of people that are going to be appointed, have to be confirmed for appointment, and all of that. You're going to get a reasonable outcome in the back end of the curve. I don't think you're going to get a drop in long-term rates, but you know what? You haven't gotten a drop in long-term rates. We got to 4.25 basically 3 years ago, and we're still at 4.25. We've been plus, minus. You're going to get a lot of variability in the data, but you will get lower short-term rates. This is very positive for markets. In terms of corporations, they can deal with a little bit higher inflation. And with the tariffs, we're going to get a little bit higher inflation. But the Fed and the market overall is not going to demand higher real rates across the curve because the private sector economy can't pay it. And that's what you're seeing. I think that's why you had excess reserves piling up, is because nobody wants that money at that rate. And that will kind of cap private sector yields. Treasury yields will push up against that a bit, but overall that's an environment where higher yielding fixed income product continues to outperform.
We've seen a lot of demand for that.
I don't think the yield curve is going to get away from us. Yeah.
Stay with us. More Bloomberg surveillance coming up after this. Let's stick with inflation and the path forward for the Federal Reserve. Veronica Clark of Citi writing, the worst-case scenario for tariff-related inflation has been avoided. The biggest test of tariff pass-through dynamics will likely be data from August through October. Veronica joins us now for more. Veronica, good morning.
Good morning.
You noticed the same line on inflation. Is transitory back at the Federal Reserve?
That word specifically, probably not. But yeah, this is a Fed that's setting up to look through maybe multiple months of some stronger inflation data. Obviously, it's going to depend on the details. Do we see services inflation slowing? Are inflation expectations anchored? But yeah, that was a pretty dovish comment from Chair Powell.
If they're saying look through it, then basically the market is only going to be focused on what? The labor market?
I think that's the most important. And there definitely, can be some stronger inflation scenarios. We don't know exactly how this will all play out. But I do think it's probably the case that, demand is soft enough. So you're not really getting these big price increases all at once. This could be somewhat drawn out. And that comes down to the demand backdrop, which is the labor market. If the labor market is slowing, that's what they're going to be much more focused on.
Based off all of this and Powell's speech on Friday, is the Fed basically accepting that they'll never hit a 2% inflation target again? Or at least in the foreseeable future?
Yeah, I don't think so. I think at some point, if we really are sticky at something like 3%, that they won't be comfortable with that. But we will have, this multiple month period of some stronger data, but it won't necessarily be the true persistent kind of inflation that would get them concerned. And then maybe a year or so from now, we're back towards 2%.
I find the analysis of the labour market slightly more controversial. This was an individual that sat at the news conference a number of weeks ago. Predates NFP, sure. But think about what he said at the news conference. Labour market's solid, anchored the view around the unemployment rate. A few days later, what did unemployment do? Not a lot compared to the massive negative revisions we saw in payrolls. Now, I'll spell out basically what he told us on Friday, and you can give me your analysis of things. Essentially, the chairman is saying that, yes, we've had a step down in supply and a step down in demand, which has kept the unemployment rate pretty stable, given everything that's been going on. But I'm going to put more weight on the step down in demand. Now, that's your camp. I understand that. But surely for the Federal Reserve, shouldn't they be focused on measures of slack? Shouldn't they be able to sit there and say, yes, demand's seen a step down, but measures of slack have remained stable, so we can remain on guard for inflation?
Yeah, I think if we don't see the unemployment rate moving higher, it will be hard maybe to get certainly bigger, cuts all at once. We're not expecting 50s. But I think the issue, and Powell did still talk about, the labor market this way in July, is why is demand weakening? What's going to stop that? If rates are restrictive, rates are probably not where they should be then.
That's a fair comment. Just how restrictive are we then?
I think rates are restrictive. Obviously we look at the long run dot, like markets, we're pricing, that five more cuts or so. But I think if you look at something like housing, that's a really good example of you don't even necessarily need rates to go higher. You just leave them at restrictive levels and you've gotten that contraction again.
John's been bringing up the point, though, when the Fed cut last year, it actually didn't help the housing market because mortgage rates actually went up.
Yeah.
How concerned are you that this is going to happen this time around?
Yeah, I don't think we're really concerned that 10-year yields are going to go too much higher if the Fed is really cutting. We saw that on Friday. A dovish chair means 10-year rates lower too.
You also said we don't expect 50s, meaning do you expect a cycle of cuts?
Yeah, we do. I think it is harder to get those big cuts at this stage, at least starting with that. Obviously rates were at a higher level last year. You weren't as concerned on the inflation side of things. But I think this is a Fed that's going to proceed with a series of cuts.
What are you expecting for 2026? And is there a dividing line between what happens before May and what happens after May?
We are still expecting that this is going to be a Fed that is data dependent. Obviously, they have to, majority vote to, have a policy reached. We still think it's a consecutive 5.
A consecutive 5. So you don't think a whole lot changes when we get that new Fed chair?
I don't think necessarily. Yeah, we'll obviously.
Where does that thinking come from?
I mean, there is obviously a lot of pressure on them, but I think it depends obviously on who the chair will be. If it is someone like Governor Waller, market's very familiar with him. We know exactly how he thinks.
Governor Waller would be a super comfortable choice for Wall Street, I think, at this point.
Absolutely. He's someone that Wall Street really admires and backs at this moment. Even if they don't agree with his view, they think he's credible, and they think he can represent an independent Fed and not someone that's just doing White House bidding like maybe the president's own NEC director.
Can we just finish on the balance sheet? What do you think the approach of the new Fed chair will be to the balance sheet? Yeah,
it's really not gotten a lot of attention. It could be interesting if it's someone like Governor Waller. He's been a bit more hawkish on the balance sheet, allowing it to run off for longer. But I imagine for now it's just as is.
I've picked up on the same dynamic. I've been very surprised sat here that there hasn't been more attention on the balance sheet. If you listen to what the White House wants, it's not just lower rates, it's lower borrowing costs, it's lower mortgage rates, which begs the question, if you're not going to get it through adjusting short-term rates, do you have to get it through other means?
Right. There's really not a lot of talk about that right now, but they are very focused on cuts, especially because they are issuing so much in the short end, so that really does depend on what the Fed rate itself is doing. Obviously for consumers, 10-year mortgage rates, all of that matters more. But for now, if it's federal borrowing costs, that depends on what the Fed's doing.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.